The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rally in U.S. stocks, a sell-off in Chinese equities, and indecision once again in the bond market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Here's where things stand with 1 hour to go in trading. You have the S&P 500 and stocks overall at session highs, gaining 0.9%, so recovering from the worst drop in about a month. Big tech, specifically NVIDIA, leading the way here with the Magnificent Seven up 1.5%. Now, we've seen this relentless move higher in Treasury yields. That has slowed just a bit here, and you can see largely unchanged for the 10-year at 4.03%. Oil also snapping its 5-day rally, lower by more than 4%. It's back below $74 a barrel on reports that Israel is more likely to target Iran's military facilities than the country's oil or nuclear infrastructure.
Yeah, what that chart doesn't show is the lesson in expectations that we got today, particularly when it comes to the stimulus-induced market rally in China, a rally that had lifted the NASDAQ Golden Dragon Index 37% in less than 2 weeks, but that index giving back about 7% today. This after China's Economic Planning Agency announced $28 billion in stimulus. That's a paltry fraction of the almost $500 billion fiscal package analysts had predicted.
This is not some sort of grand structural pivot. It's not a whatever it takes moment. And so you have to have much more modest expectations of where things are going from here.
That disappointment reverberated through oil and metals markets, but fortunately it did stop short of U.S. stocks, which found renewed strength today on the back of big cap tech. So for every massive drop that we had in Chinese ADRs like JD.com, Alibaba, and Baidu, we're seeing massive bids into names like Apple, Netflix, and NVIDIA. In fact, NVIDIA on a 5-day win streak right now that has taken it to just about 2% away from reclaiming a record high that has stood since mid-June. Meanwhile, we do continue to monitor the size, speed, and trajectory of Hurricane Milton and the mandatory evacuations around the Tampa-St. Pete, Florida area. That's an area of 3 million people, and it has become one of the fastest growing metropolises in the U.S., adding at least 1 million residents over the past 20 years alone, and about 70% of that growth all attributable to net migration to the area, including a thriving financial industry hub that includes major offices for J.P. Morgan, Citigroup, Raymond James, and of course, ARK Investments, just to name a few, Scarlett.
All right, but when we go back to the financial markets, investors really still adjusting to this new landscape. When it comes to Fed policy, here's how traders see the rest of the year shaping up. They're now pricing in a 25 basis point cut in November. Those are the white bars. And in December as well. Those are the blue bars. That's in the wake of the September jobs report, which, remember, showed better than expected job growth and an unexpected drop in the jobless rate. That is a sea change from early September, right around here, when traders were anticipating a combined 80 basis point reduction in the final 2 meetings of the year, something like a half-point cut and then a quarter-point cut, or vice versa. Romaine?
And this gets us to the question here as to what the market is actually trading off of, or at least what they think they are. Dennis DeBusschere joining us right now, President and Chief Market Strategist over at 22V Research. Dennis, great to have you back on the program. Let's start with monetary policy. Let's start with the Fed, and let's start with the expectations, or maybe the rethink of expectations as to where rates are going to go.
Yeah, so I think it's important to keep in mind that, interest rates going higher, meaning the 10-year yield, because economic growth is better than expected, is not a bad thing. The Fed cutting less because economic growth is better than expected is not a bad thing. And let's be very clear about this. What I'm talking about is less upside risk to the unemployment rate, right? The risk, just last week, remember where we were? There was a manufacturing ISM that was bringing forward had a very weak employment reading. It was a weak manufacturing ISM. People are worried about a recession. Fast forward 2 days, unemployment rate's lower. That risk of near-term recession is much lower, so the Fed has to cut less. In aggregate, though, financial conditions didn't really change. They are easy. And if financial conditions are easy, growth in the future is going to be better, and that's good for earnings. So overall, It's not a bad thing that we're having less cuts now and 10-year yields are drifting higher a little bit. That is not a bad thing at all for the market because financial conditions are still supportive.
Absolutely. And I am curious, though, as to the price action that we're seeing in the equity space, where a lot of the buying today is once again back in those big cap names. And obviously they benefit from that growth story. But I would think if they're going to benefit from that, wouldn't some of the mid cap and small caps also benefit from that as well? Why aren't we seeing more buying there?
Yeah, it's a good question. Remember that October tends to be, especially in election years, tends to be seasonally unusually weak. And it makes sense, especially going into this election, because, well, there's a lot of uncertainty. If there's a sweep one way or the other, there could be a potential event in treasuries. Who knows when we're going to figure out who actually wins? I mean, there's still some risk of that. So I do think there's election risk that's going to hold things back near term. You have geopolitical risk, right? So it's much better or easier to own NVIDIA right now on lower oil prices than it is, if they come down a little bit on the day, than it is maybe some of these other, I should say higher oil prices, than some of these other riskier names if we're, do not know what Israel's response is going to be. So there's a lot of uncertainty right now that's just unusual and short term that I think is holding back the average stock, if you will.
How are you thinking about energy stocks, Dennis? I ask because of the move higher that we've seen in oil, thanks to that geopolitical premium, certainly giving investors a reason to just buy energy stocks as a knee-jerk reaction. At the same time, do you see the earnings growth there to support the gains that we have seen over the last couple of days?
Yeah, I would say as a general rule, if you need the potential of strikes on oil facilities in Iran to drive oil prices higher, it's not the best reason in the world to own energy stocks. China's stimulus maybe was going to be some help as far as global demand is concerned, but you're not going to get the type of stimulus in China that's going to be globally reflating. U.S. demand is okay, so it's very difficult to embrace energy stocks right now based on geopolitical risk going higher because geopolitical it's come and go. I mean, 2 days from now, if we have a more benign resolution, I shouldn't say resolution, but more benign outcome on the Israeli-Iranian front. Oil prices could be down significantly. So it's just very difficult to chase energy stocks in this type of environment.
Right. I was taking a look at the S&P 500. It has not been able to string together 2 straight days of gains or losses in about 2 weeks. Do you read this lack of positive or negative impetus this directionlessness as bullish or bearish?
I view it as unusual uncertainty ahead of the election. I think ultimately it's bullish. So if you look at tail risk hedging right now and put call spreads on some very large declines, what people would call tail risk hedging, so like a 10% probability event or 25% probability event, it's unusually high, meaning bidding up puts relative to calls. So as long as you have that tail risk hedging at usually high levels, you're going to get this kind of internal noise, if you will, day to day until some of the events, particularly the election and geopolitical, clear. Ultimately, that is positive, assuming they clear in a benign way. I think the election, no matter what the outcome, is probably a positive clearing event. It's just we have to get through it. On geopolitical risk, obviously, you can't be as certain. But tail risk hedging at elevated levels like they are now has historically been very positive longer term.
Do you feel, when you look at this market right now, Dennis, at least what we know publicly, does it feel diversified? Does the sentiment, does the positioning seem diversified to you?
No, I mean, if people keep on piling into the same winners, for the right reasons. I mean, these extraordinary profitable companies, and they're doing very well. But you had some bounce of the equally weighted index. You had some bounce in small caps. But if you look at values, multiples relative to growth, I mean, it's in like the 4th percentile historically, meaning your next 12-month multiple in value relative to growth. You can say the same basically for small caps. You can say basically the same thing for a lot of the riskier factors. So people are way overweight quality. So it's not balanced relative to what you would expect in a normal economic expansion, which we're in. We're in a normal economic expansion. No one wants to believe it, but that's what we're in. I get the risks around that, but that's what's going on.
Based on that, though, Dennis, should people continue to bet on this idea of multiple rate cuts by the Fed over the next 12 months? And when I say multiple, I'm really talking about going 4, 5, 6 times over the next 12 months.
Yes, I think the direction of travel is clearly easier monetary policy. Unless we're shockingly wrong on the inflation outlook, expect the Fed to slowly get to neutral over time. That'll get you 2 more cuts this year. Again, unless the CPI data Thursday is much worse than expected. You're going to get the 2 cuts. Then you get a few cuts next year, depending on the data, comes in. Under our forecast, relatively strong data, inflation's still benign. You get a few more cuts to get back to neutral. So yeah, that's the direction of travel. Monetary policy is basically easier financial conditions, which all things equal, you don't want to short, right? I mean, it's very difficult to be short the Fed cutting, even if it's not as fast as some people hope.
How are you thinking about the positioning and the likelihood of a violent reaction one way or another with the CPI report due to come out on Thursday?
Man, I mean, the whispers here keep on going higher. So I think people are set up for a potential miss. When I say miss in CPI terms, it means hawkish. So you're seeing some banks come out at 0.3 on month versus 0.2 expected. Given the move in rates and oil recently, yeah, you could get a pretty violent reaction if it comes in a little hotter. The other side of that, though, is given how high rate volatility is, man, you could get a significant internal reversal, almost like we saw on Friday with small caps, et cetera, if you just get in line. So there's going to be a significant amount of volatility around CPI, given how much the narrative has shifted post-payroll.
All right, Dennis, great stuff. Dennis DeBusschere, President and Chief Market Strategist at 22V Research, kicking us off to the close here on this Tuesday afternoon as we continue to keep an eye on shares of Roblox, moving lower on the day after Hindenburg Research betting big against the company. It's the latest big short that they have. We're going to talk about exactly the claims they made and Roblox's response. We're also keeping an eye on shares of PepsiCo and why the stock is fizzing up despite the snack maker's latest warnings about future revenue. And from soda to wine, Ayesha Curry and Sydel Curry-Lee sitting down with us to discuss their venture, Domaine Curry, and a big partnership with the folks over at Constellation Brands. That conversation a little bit later in the program. Stick with us. This is The Close on Bloomberg.
Space, the next frontier of the tech sector. On Friday, Bloomberg Technology is live in LA for a special episode from Rocket Lab, featuring conversations with founders and investors of the companies plotting humankind's future outside of Earth's atmosphere.
We're going to get hands-on with the future of space technology, from rockets to robots.
Countdown to 11 a.m. Eastern, 8 a.m. on the West Coast, only on Bloomberg Television. Context changes everything.
Recent liquidity pressures in U.S. funding markets have some folks on Wall Street nervous about a volatile end to 2024. A large part of that due to a spike in interest rates tied to repurchase agreements. Bloomberg's Alex Harris is the authority on all of that and joins us now. So we're talking about the repo market. Yeah. Why is there concern that repo rates could spike in December?
Well, so here's the problem with the funding markets and the way that the plumbing of the financial system is working right now, is that what people are concerned about ultimately is mobility, is that you have this cash sitting there, but it cannot move. And so one of the big issues, and what I think people are really seeing when they evaluate what happened at the end of September, is that we have a balance sheet problem. And this means that the primary dealers, there's only so much balance sheet they have available to do what they need to do. And repo is a very low margin, but balance sheet intensive business. But it's very important to ensuring that, the market gets financed, treasuries get financed, that it lubricates the market. But the problem is you have a Fed that's still winding down its balance sheet. And so those securities, those treasuries that mature, those get reissued back into the private market. So those go back onto the dealer balance sheets. Then you still have Treasury having to finance its deficits. And so there's a whole ton of debt sitting on the balance sheets of the primary dealers too. So with primary dealer holdings of Treasuries near all-time highs, things are just getting stuck. You cannot do what you need to do. And so really that came, while we had been seeing pressures for the past few months, really in sort of what we call off days in the market, just like in every regular day. Now we really saw them intensify on those days where you don't have balance sheet because you have, regulatory snapshots and other things that you typically see at the end of the month or quarter.
But are we seeing money come out of the repo market yet in the same way, or at least to some degree, on what we saw back in 2019?
It's not that. Yeah. It's just that cash is really just tied up and there's not really a place for it to go. There's a corner of the market called sponsored repo, and it allows basically dealer or sponsored banks can be an intermediary between cash lenders and cash borrowers. That's seen a lot of pickup. That I think at the end of the quarter, volumes there were 1.78 trillion, like all-time highs. I mean, this market barely existed in 2019, and so that's actually alleviated a lot of the pressure and actually been propping up the markets and preventing a blowout like we saw in 2019.
But what has the Fed said about this? I remember seeing some comments maybe at the end of September, out of Roberto Perle talking about they're keeping an eye on it, which you would hope they are.
Yeah.
But have they actually articulated what they would do if we did reach stress?
I think they're just sort of hoping that the tools they have in place are going to be it, that are going to help keep a lid on short-term interest rates. But when you saw what's called the standing repo facility really be battled, or at a moment where it could be battle tested, which was on the 30th, $2.6 billion borrowed is what the counterparties did with it. That's not very much. It's the most we've seen them do since they made the facility permanent in 2021. But they haven't, that's really not a lot when you think about it. And overnight repo rates still went to 5.9%. So something's clearly wrong there. You know, people point to the mechanics of this facility being a bit off for the purpose. It's too late in the day. If you need to get your funding done and your balance sheet available, you do it first thing in the morning. And the problem is that it's not centrally cleared, so you can't take it off the balance sheet. So it just sits there. So if you already have a very tight balance sheet, you don't have the room to do this.
That's a great point, and I think something we need to bring you back on to talk about, because I mean, there's a lot of questions about whether this whole facility is just kind of outdated in terms of its structure to begin with. Alex Harris, who covers this for Bloomberg News, a closer look at some of the potential stresses, maybe, if you will, in the short term of the financial markets. When we come back, we're going to talk Pepsi, a rough yet resilient third quarter as the company faced cash-strapped consumers and geopolitical tensions. But now the drink and snack maker saying it needs to scale back its sales forecasts. We're going to recap the results and get some insights out of one of the best analysts on the street. That's coming up on Top Calls. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we start off today with Humana. Bernstein lifting its recommendation on the health insurance company to outperform, saying that the risk related to last week's 25% sell-off are now priced in. This, coupled with improving sector outlook and potential upside catalysts, that warranted the upgrade, though the analyst did slash his price target down to 308 from 405. The shares getting a modest bid on the day of about 2.5%. Next up, let's take a look at American Express, hit with its third downgrade this week. BTIG today cutting to sell, saying fundamentals for super prime borrowers are slowing and will get worse even in a soft landing scenario. The analyst doesn't believe that American Express can grow with Gen Z borrowers, especially in non-AI tech employment. And finally, investors pouring one out for Constellation Brands. The beer maker cut the hold from buy over at TD Cowen. The analyst says Constellation not immune to an industry-wide growth decline for beer, especially as a turnaround of the wine and spirits sector takes longer than expected. Those shares down slightly on the day, and those are some of our top calls. We do want to stay in the beverage space, but of the non-alcoholic kind, and turn to PepsiCo. Shares of the soft drink and snack company are been oscillating all day long here after its third quarter earnings report. Pepsi did trim its organic revenue outlook for the year, and there are some concerns here about whether what's ailing Pepsi is more of an industry-wide problem or just idiosyncratic to that company in particular. Lauren Lieberman joining us right now, equity research analyst at Barclays. She has an overweight rating on Pepsi shares. Pepsi investors really taking this in stride, Lauren, but I do want to go through some of the numbers here, because when we talk about beverages here in North America, that was down. When we talk about Frito-Lay here in North America, that was down. We also saw some softness in overseas markets as well. Can you and then there's a whole Quaker Oats thing, which is its own story here. But let's start with the snack business, because I thought that this was kind of the ballast for this company. What is going wrong there?
Yeah, so you're absolutely right. Frito-Lay North America, hallmark of this company. So that is a very fair statement. So it got a little better. I mean, down 1% volume this quarter was a significant improvement from down 4% last quarter. So what's been going on? They took a lot of pricing over the last couple of years, as there has been across the consumer packaged goods industry. The consumer seems to have hit a wall, right? About 12 months ago, you started to see some slowdown in categories, including salty snacks, and that worsened over the summer. So initially, all that pricing that went through, consumer was resilient, took it in stride, volumes were pretty stable, and something seems like it finally tripped. They did start to reinvest in, as you call it, value, so much more promotional over the summer, particularly on Lay's potato chips, which helped get some sequential improvement in the business. But it really is, I think, mostly a matter of pricing, of value to the consumer, and some weakness in the consumer environment like we've seen broadly.
Do you think we're going to see more promotions by PepsiCo?
I do. I mean, I think what started this summer was just the beginning. They used language today over and over again around being responsible, prudent, disciplined, those sorts of things. So it will be targeted. This summer was all about potato chips. In the fall, there's going to be more activity on brands like Tostitos and Ruffles. They talked about having bonus packs, so 20% more product in the package on those two brands in particular. They discussed them being very central to football season and entertaining. So piece by piece, they are definitely working their way through the portfolio on those core brands with more promotion and to drive better value.
So the CEO, Ramon Laguarta, talked about how consumers are definitely looking for more healthier options. Does that mean that PepsiCo is looking to maybe unload some of the brands in its portfolio, like Cheetos, for instance?
No, they love all their children. I think that's a very, very, very true thing. But what's important to remember is that when you go back to the company's prior CEO, Indra Nooyi, I mean, she really saw the future in terms of healthier options and more permissible snacking. Perhaps they pivoted too far during that time in favor of that healthier segment of the portfolio. Under Ramon's leadership, it's been we need to let the consumer have their Doritos if they want their Doritos. So it's a both, not an either or. But right now, the task at hand is bringing back more transactions, more activities to the core, the sort of less healthy. But they are absolutely concurrently investing in those more premium and better for you, more permissible, as they put it, products.
So given that Pepsi is often compared to Coca-Cola, but Coca-Cola doesn't have a snacks business, is Coke the better option here for investors who want some kind of exposure to the drinks market, but don't really want to deal with waiting out to find out whether the snacks slowdown is cyclical or structural?
Yeah, I mean, we're recommending both of them, which might seem, like you can't do that, but I am. Look, on Coke, I love Coke for the global growth story. The category development opportunity in packaged beverages is a big one and a long one, and Coke's international presence is tremendous, and their capability in terms of execution, not just in the U.S., but in non-U.S. markets as well. Pepsi will be interesting for investors who want more of a turnaround story. And I do not think that Frito-Lay is dead. I think this business will come back. I think they will make the requisite investments to make this business as relevant as it's ever been for consumers. Valuations between the two stocks are very different right now. So that's why I like both. You get a turnaround at Pepsi, but you've got, kind of set it and forget it trajectory at Coke.
Got it. Lauren, really appreciate your joining us today. Lauren Lieberman over at Barclays giving us her take on Pepsi's latest earnings and its reduced outlook for sales. Coming up, we're going to take a deeper look into China's economy after Golden Week with Vivian Lin Thurston of William Blair. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And looking at the markets today, the S&P 500 has recouped all of its losses from yesterday. It's been a stealth rally today.
Yeah, kind of interesting to see the enthusiasm that you're seeing in U.S. markets today, despite, the pessimism yesterday, which I'm not sure was warranted. And then you overlay that with what's kind of a really weird market right now in China. You had mainland stocks reopen after a long holiday.
Yeah.
You actually saw a rally in those mainland Chinese markets, but then Hong Kong sold off, 9%? And then, of course, you have all the U.S.-based indexes and ETFs like the K-Web and FTI and the Hong Kong Golden Dragon Index, all down 9, 10, 11% here on the day, giving back some of the gains off of that two-week rally we had coming into today.
Yeah, I talk about the S&P 500 at session highs. The Golden Dragon Index still down about 7.4%, so not really giving back or clawing back much of its losses from earlier today. So clearly, Chinese stocks getting rattled here as investors reassess all their stimulus bets. By the way, the Golden Dragon Index is now at its lowest since November of 2022 because Beijing stopped short of issuing fresh stimulus measures to bolster the economy. Joining us now for more on what's going on there and how to read through all of it is Vivian Lin Thurston. Vivian is partner and portfolio manager at William Blair. And the disappointment, Vivian, lies with the fact that Beijing only announced that 200 billion yuan in spending would be advanced from next year, when analysts were forecasting a fiscal package worth as much as 3 trillion yuan in the pipeline. Who's in the wrong here? Did analysts and traders just get ahead of themselves here?
Yeah. I think the market expectation definitely set up to be more than 2 trillion renminbi fiscal spending, and then the higher number can be even up to 5 trillion. But the NDRC kind of a meeting didn't really specify about this. First of all, it's not their jurisdiction to talk about fiscal spending. That's more Ministry of Finance kind of job. I think we'll hear more this weekend. So as a result, I think market kind of take it as a disappointing signal. But I feel, practically speaking, we're probably not supposed to hear anything from them anyway. But in terms of the market movements, actually, if you think about since the end of September, when China first came out with a monetary stimulus policy on September 24th. From that point until now, even with overnight sell-off of the MSCI China index, the index is still up about 32% in dollar terms. So it's quite substantial.
Yeah, no, that's a good point. But, you know, in the days leading up to Golden Week, Beijing methodically announced all these policies to support the property and the stock market. It was like a daily treat for investors. Did it set up an unrealistic precedent, an undeliverable precedent to continue doling out positive catalysts on a regular basis in order to keep this rally going?
Yeah. I mean, this is definitely not realistic or practical, right? Any stock markets should never work on just policy stimulus to that extent, because at one point, even the stimulus policy will run out. So I think eventually the market will come back to see what does this mean? What does this mean? Whether fundamentals of the China economy and the corporates will continue to start to see the improvement. So we see the early phase, you tend to see some more opportunistic money also comes into play this asset class, given that it was oversold before. But at one point, I think the fundamental investors like us, William Blair, will start to look at whether all the policies will trickle down to the meaningful improvement of the economy and the corporate fundamentals.
Well, that's what I'm curious about, Vivian. I mean, from a foreign investor's perspective, people tend to sort of look at China as the China markets, I should say, as kind of just one big basket. I am curious as to whether there are certain sectors and other sort of pockets of that market that are going to benefit from the current stance, even though it might have been significantly lower on a dollar and yuan basis than what people wanted.
Yeah. A very good question. You're absolutely right. Most investors probably look at China as a beta play, which is typical in this early phase of this policy expectation. But we tend to look at what are the industries and companies already show some improvement on the fundamental side and will continue to benefit from the future government policy to support domestic consumption, for example. So we do look at some of the companies, industries such as e-commerce, internet, online gaming, some financial services and industrials companies, and definitely food and beverages and beauty. So those industries, we believe, will continue to benefit from the consumer recovery and also the beneficial government policy to support domestic consumption. Yeah.
With regards to domestic consumption and the health of the consumer, because that's obviously a big bet that foreign investors are making, really wanting to take part in that large population and obviously growing wealth in that population here. What's holding back greater growth in consumer spending right now?
Yeah. So first of all, it's confidence. So this prolonged cyclical downturn of China is led by the lowest consumer confidence and business confidence in the last 20, 30 years. So when there's a confidence-led kind of downturn, you need to restore and repair the confidence. And interestingly, that there has been estimates about excess savings in China since COVID. We're talking about $5 to $6 trillion excess savings, meaning that Chinese consumers, they put the money away because they have no confidence about future. Therefore, they don't spend, they don't invest, they don't purchase house. So this is not an affordability issue. In my view, it's more confidence issue. And so that's why we see government start to come out with more determined kind of attitude shift in recent time to stabilize property market, which is tied with the wealth effect of Chinese household quite a bit, and also to repair and restore the consumer confidence.
Okay, so that's what the government is doing when it comes to domestic consumers and domestic investors. How intent is it on trying to appeal to foreign investors? We talk about how U.S. investors are underweight, if at all, to Chinese stocks.
Yeah. Foreign investors tend to look at the asset class from both the risk premium perspective and also potential return perspective. So the interest rate cut by Fed actually already led to more interest from global investors looking at emerging countries, including China. And so that, I think, explained part of the flow in recent times. And secondly, as China policies start to shift more positively and more supportive to the economy, we should see improvement of the macro, and that also attracts foreign investors. So even though the direct policy not really targeted at make the foreign investor feel better, but the outcome gets to the result. Yeah.
All right, Vivian, going to have to leave it there. Vivian Lin Thurston over at William Blair, a closer look at Chinese markets and the stimulus that maybe came in a lot lighter than what the market was expecting. We turn our attention back here to the U.S. and some of the big movers on the day, and that includes Roblox. The share is moving lower here after short seller Hindenburg Research dropped a new report accusing the gaming platform of issues relating to how it accounts for some of its key metrics. The company itself calling the claims misleading. We're going to discuss coming up in a second, right in our Stock of the Hour on The Close on Bloomberg. All right, time now for our Stock of the Hour. Keeping an eye on shares of Roblox, well off the lows of the day, but still significantly lower. This after Hindenburg Research released a report alleging that the gaming platform has inflated key metrics and not done enough to address child safety concerns. A spokesperson for Roblox did respond in a statement rejecting the claims made in that report. Mandeep Singh joining us right now, who covers this company for us over and our fine folks over at Bloomberg Intelligence. All right, let's start off with this. There's a lot in this report, and Hindenburg, of course, has been right in the past. I feel like a lot of the allegations in here have been kind of floating around in various media stories for the last few weeks, if not months here. When you saw the allegations in the Hindenburg report, were you surprised?
I was not, and what I was looking for in the report was the scale of the problem. Mm-hmm. Yes, child safety is a concern with a platform like Roblox, but I also know there are brands like Walmart and L'Oreal, who advertise on Roblox. So clearly, among all the gaming platforms that are out there, Roblox is one of the best. Mm-hmm. And look, when it comes to child safety and instances that they cite in the report, how many hours are like that, or what kind of scale are we talking about? Because Roblox does 50 billion hours in a year. Yeah. So they definitely have the scale. It's not an easy problem to solve. And we know the companies with scale, like Alphabet and Meta, have applied AI for content moderation. That's what's helped them. And that's a good point, too. We should point out a lot of other social media platforms have dealt with similar issues with varying degrees of success. There's a question there about whether that content is more accidental or incidental, if you will. What is not accidental or incidental, at least in terms of allegations, are these key metrics and the way that Roblox measures its audience. Do you find, I guess, are you comfortable with the way that they measure their audience? Well, I mean, we know what these companies are measured upon. It's the user growth and the engagement growth. And I could say, when you compare the social media platforms, it's not apples to apples. The way Snap measures their user growth versus the way Meta and YouTube does. There's always a degree of, judgment that these companies have in terms of showing what is their user growth in the quarter. So until the regulators say this is how you measure user growth, it's very hard to make a case that, they are deliberately inflating the numbers. And I don't think we want the regulators making that decision. Well, the CEO certainly doesn't want that. In fact, the CEO has said that he wants a goal of 1 billion daily active users. Currently, they're at about 80 million. This is a stock that's down for a 6th day. It's come off its lows, but it's losing 12% so far this year. And it's kind of been struggling for a while. What is the bull case here for Roblox? Why would investors like it and believe that the CEO can get to 1 billion daily active users? I mean, the bull case is this is a 20-year-old company that has really carved out a niche when it comes to online gaming, and that to user-generated content. Remember, you have a lot of, branded titles within gaming world. Roblox is just a platform. They're not creating content. They're creating a gaming engine where users are creating the content, and they are policing and moderating it. Obviously, they're not doing a great job at it, which is why we have this report. But I think there is no other platform like Meta. They have so many properties, but you can't play games on Meta properties. And same with YouTube. You have a lot of video content, but you don't have gaming content. So clearly, I think Roblox has a niche. And I think to go back to your point about 1 billion users, That, I think, is a very far-fetched scenario in terms of, given their demographic is 9 to 20-year-olds, how do you get to 1 billion? You have to expand in other categories, and I have my doubts there whether they'll be able to do that successfully.
Does Roblox fit in better as part of another company, as a part of a portfolio of other brands, as opposed to a standalone company?
I mean, it could. Look, it's a founder-led company. He has been running this company for 20 years. He's over 60-year-olds. You could argue, what his motivation is to take the company to 1 billion users. But so far, we have not heard anything. In fact, the CFO is leaving at the end of the year. So that's also something to look for, in terms of management change.
All right, Mandeep Singh, thank you so much. Senior technology analyst with Bloomberg Intelligence. My personal experience with Roblox as a parent, I want to strangle it if it were an actual person.
Okay.
My child spent too much time on it, too much money on it.
I have a little bit better experience with it. And it's funny because I have noticed, I haven't even seen anything extreme content, but I've certainly noticed some things that maybe you're kind of like, oh, should my child really be looking at this? But I do wonder, again, if this is just incidental, just a lack of sort of paying attention rather than something deliberate.
Right. Well, more to come. And of course, this is a story we'll be monitoring continuously. Next up, we're going to go over the closing bells in the lead up to it with Lauren Goodwin, economist and chief market strategist at New York Life Investments. This is a close on Bloomberg.
I think people are set up for a potential miss. When I say miss, in CPI terms, it means hawkish. So you're seeing some banks come out at 0.3 on month versus 0.2 expected. Given the move in rates and oil recently, you could get a pretty violent reaction if it comes in a little hotter.
Dennis DeBusschere, president and chief market strategist over at 22V Research, kicking us off to the close just about 50 minutes ago, Scarlett. And it's kind of interesting, too. I mean, he talked about this whole idea, sort of, I don't know, whether the market is getting over its skis or whatever the euphemism is here. I mean, he seems to think so, but he also seemed to be relatively sanguine about the idea that there are a lot of pockets of this market that he finds attractive, or at least on a relative basis.
Yeah, my big takeaway from that conversation was when he said higher rates are not a bad thing because rates are going higher for a good reason. The economy is doing better than a lot of people anticipated. The S&P 500 is not too far from its record high. It's up at session highs right now, gaining more than 1%. And it feels like the summer all over again with the Philadelphia Semiconductor Index, the Mag 7 all doing well. You look at the SOX Index, led by Intel, led by NVIDIA. June 2024, anyone?
Yeah, absolutely. Actually doing pretty well. 57.54 at one point. We were above 57.56 and change here. So just really about 4 or 5 points away from that all-time high. Kind of remarkable here, given just how much volatility we continue to see in this market. And that really boils down to a big difference of opinion into not only where we are in this market cycle, but in the economic cycle as well. So who better to bring on this program than an economist and chief market strategist all rolled into one? Lauren Goodwin over at New York Life Investments joining us here in Studio 2. Great to have you.
Thank you for having me.
Let's start off with the valuation question, because there was a tinge to the rally that we had prior to the ructions that we just had, that those valuations were sort of being addressed by that drop in rates or the potential drop in rates. It seems like the betting now is that rates aren't going to drop much further than where they are now. Does that change the valuation on equities?
Couple of really important things to acknowledge about equity valuations. The first is that, yes, if you expect that rates are not going to come down as much as maybe you might have thought a couple of weeks ago, then you would expect price multiples not to expand quite as much. But rates are still moving lower, so I don't want to overstate that point. And we do have an environment where profits are still very much supportive of an equity market environment. I think, though, importantly, we're also just ahead of an election and earnings cycle that are likely to give us and investors stronger clues directionally on valuation levels. And so I don't see that as a major impediment to the market moving forward when, again, profits have been so strong.
And that earnings cycle is basically here. I mean, it kind of kicks off tomorrow, and then we get the banks starting on Friday, the big banks. And I am curious as to, at least based on what we've heard so far, whether it's through pre-announcements or just media reporting, are you encouraged, or are you heading into this earnings season optimistic about what we're going to hear and learn from these CEOs and CFOs?
I am, let's say, cautiously optimistic because the economic data that we saw for Q2 in terms of corporate profits has only been revised higher and higher. And so though typically this is a time of year where analysts start to downgrade their earnings expectations for the end of this year and looking forward, we are not seeing an economy that, though slowing, is really in trouble. And so it's an environment where I expect, on average, companies to look quite resilient. Maybe some of that profits maintenance is coming from sustained cost cutting, but that's a relatively healthy environment. I think the biggest risks, of course, are to the big names where any miss in any direction is potentially challenging, but I don't see any reason to expect that.
How much do you think we're going to glean from these CEOs on these conference calls and in their outlooks in terms of what they see in 2025? It's such a big question mark when we don't know where rates are going to be.
That's exactly right. And I expect that many, if not most, CEOs are going to point to the big areas of uncertainty that we have in the next couple of months in order to look right past that question. Not only the election, but also geopolitical dynamics have such a big voice in the path of economic growth, government spending, inflation, interest rates. Why would you make a big claim about where the economy is going right now? But one thing that we do know is that interest rates moving lower, and this surprised me, but we've looked a lot into it in the past couple of months. Interest rates moving lower, especially for small businesses, is not a major driver of new hiring or new investment. Now, I expect that clearing election uncertainty could clear the way for new investment to some extent, just getting some of that ick out of the market expectation. But we don't expect a major resurgence in hiring, despite what we saw in the jobs report last week.
Okay, got it. So as we wait for the election to come through and get past that point, and as with us on the cusp of earnings season, it feels like we're going to remain directionless or like getting clues but not taking action on any of this. Once the election is passed, are there certain, I guess, investment thesis that you see investors willing to put into play regardless of who wins?
Yes. So regardless of who wins, there are a couple of themes related to supply chain reglobalization, related to infrastructure, and specifically related to what is effectively a broadening of the AI theme, not away from the superscalers, but in addition to the superscalers. We've started to see a large surge in investment in different areas of energy, for example. That's why we see energy, utilities, even to a certain extent, real estate as interesting areas of investment. But importantly, also, regardless of what's happening with the election, the Fed is cutting rates. And even if they cut rates less than what maybe we were expecting, that's still a very important investment thesis that drives not just asset allocation, but also sector allocation.
I have one final question for you in conversation with Lauren Goodwin right now over at New York Life, but we do want to bring you some quick breaking news. This on Boeing. S&P out with a note here, placing the company's credit rating on negative watch, basically saying that Boeing could be cut to junk over at S&P. The share is moving lower here as we move closer to the bell. And Lauren, I bring that up now because I am curious about overall credit quality in the market, and with the caveat that Boeing is its own story. This is strike related, a lot of self-inflicted wounds. But there are a lot of other companies that are sort of teetering in terms of credit quality right now. And I'm wondering, were they saved by the soft landing that apparently we're getting? Were they saved by this drop in interest rates, or should we still be on guard?
I do think that interest rates moving lower, especially for floating rate borrowers, and bank borrowers, which is a lot of small businesses in this economy, it does help. We are hearing not only from our high yield teams, but also our private credit teams, that moving rates even 50 or 100 basis points lower is a big boon to their borrowing portfolios as a whole. And so I think it does make a difference. It doesn't necessarily translate into a reacceleration of growth, stronger hiring, but I do think that it matters. What it does mean, though, if we have what is at or maybe just below trend growth environment with moderate inflation and slightly lower but still relatively high interest rates, that is an environment where manager selection, security selection becomes more important. And so selectivity and paying attention to credit quality, of course, late cycle, paramount.
All right, Lauren, always a great conversation. Always appreciate you stopping by. Lauren Goodwin is economist and chief market strategist at New York Life Investments, helping us count you down to those closing bells. Scarlett, with stocks not far off session highs right now.
Not far off session highs, not far off record highs, too, as well. And we have the chip companies, the Mag 7 really leading the way here.
Mag 7 stocks out in front here on the day. A full breakdown of all your market action coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through the Closing Bell, a global simulcast. It starts right now with Carol Master and Tim Stenovic in the radio booth. Alex Seal still on assignment as we welcome our audiences across our Bloomberg platforms, including our partnership with YouTube here on a dramatically different day, Carol, than what we saw yesterday in U.S. equities.
Yeah, I think this is kind of the norm for us, right? We see just bouncing around. I feel like, we're going to count down to that CPI report. Does that change things again in terms of what people think about interest rates and what the Fed does? We just kind of bounce from tone to tone and sentiment to sentiment.
Everything's kind of higher except for energy. Saw oil plunge and hit the energy sector here in the U.S. after news from Beijing ended without new stimulus measures. So that has energy companies on edge and investors on edge. But other than that, everything else is higher.
There are a lot of catalysts in the market right now, big, broad macro factors. And also, obviously with the start of earnings season, there are going to be a lot of company-specific factors. But the consistent message we keep getting is that no one's going to do anything until after the election, until it's clear which administration will be sitting in the White House. Because until then, everything's kind of up in the air in terms of policy.
Yeah, absolutely. Though you do kind of wonder whether they're going to have the luxury of waiting here. Of course, we have a couple of key economic data points coming up, another Fed meeting, and of course, earnings season, which kicks off this week. So it'll be interesting to see what we hear out of some of these companies and whether that changes the market thesis in any way, shape, or form. We get the closing bells here in New York here on this Tuesday afternoon. And a much different day from what we saw yesterday. Green across the screen here with the S&P 500, not far from its record highs. Record high right around 57.62 and change. It looks like it's going to close today right around 57.51 as we wait for these numbers to settle. That's about 1% higher than where it was yesterday. The Dow Jones Industrial Average up about 0.3%. The NASDAQ Composite up about 1.5%. And the Russell 2000 holding on to modest gains here on the day. It's going to close higher by about 2 points or 0.1%.
Just eking it out. All right, let's go back to the large caps S&P 500. Most names, or a majority, I should say, 313 names to the upside in the S&P 500, guys. 187 losing ground, and Scarlett, 3 unchanged.
All right, let's take a look at how the sectors shake out here on this Tuesday. You have 9 sectors in the green. Tech is leading the way, and that's really semiconductors like an Intel and NVIDIA, communication services, and consumer discretionary also gaining at least 1%. The weak spots in the market are energy, and that's there we go, that thin red bar there, down 2.6% with 21 out of 22 big cap energy names in the red. Materials losing ground by about 0.4%.
Was that a zoom in on the red bar?
It was.
That was super cool. All right, let's
professionals over here, Carol Master.
So I hear. All right, let's get to some of the individual gainers, guys. Scarlett mentioned about the semiconductor area. NVIDIA up about 4%, so just off its highs of the day. It is one of the top gainers in the NASDAQ 100. Facing concerns about electricity demand, of AI computing. They touted the energy efficiency of their latest chips. That was at a conference today in Washington. We actually talked to our Ian King about the significance of it. The point is, though, if you're going to be using even more of these chips ultimately to compute, the energy demand is just going to grow as well. Anyway, I should point out shares now up about 12% in the past 5 trading days, longest streak in about 1.5 months. So it has been certainly moving higher. Robinhood, guys, up about 10% in today's trade, or just shy of 10%, surging after the company announced plans to host its first Investor Day on December 4th in New York. The company said it will share more about its vision for the next 10 or more years. We saw a lot of call options activity, too, on this one. You might remember back in a couple of days ago.
Oh, yeah.
Politico, like how you do that. Politico reported that Robinhood's chief legal officer, Dan Gallagher, is emerging as a top contender to head the SEC should Donald Trump find himself back in the White House. One more, DocuSign, a favorite during the pandemic, up about 6.5%, up the most to the highest in more than 2 years. S&P Dow Jones saying that the company will join the S&P Midcap 400 index before trading opens on October 11th. So you saw investors moving into that one.
All right, Carol, with the gainers, I got the decliners. I do want to start with shares of Roblox. They fell by a little over 2%, but earlier in the session, they were down as much as 9.4%. Short seller Hindenburg Research came out, said they're betting against the company. They said Roblox has inflated key metrics and alleged that it doesn't have sufficient safety screens to prevent pedophiles from using the platform. Should note that a Roblox spokesperson said, quote, "We totally reject the claims made in the report. The authors are admittedly short sellers. They have an agenda irrespective of the substance of Roblox's business model and results." I would just give a shout out to Olivia Carville and her story for Business Week that she wrote just a few months ago on this topic. Everybody should go and check that out. Also, to the energy sector, Scarlett talked a little bit about that and what it did in the S&P 500. Oil plunging today. We saw that hit the energy sector here in the U.S. Marathon Petroleum falling 7.7%. It was the worst performing energy name in the S&P 500 today. Fell as the top economic planner in China ended a highly anticipated briefing on Tuesday without a new stimulus measure. China is the world's top crude importer. And speaking of China, I got Carol's NASDAQ Golden Dragon China Index.
Wait.
Today. Yeah, I got it.
Stole your thunder.
Wait.
I'm sorry. You got to do it on a day.
Yeah.
It fell the most since October of 2022, 6.9% lower. U.S. stocks listed, or Chinese stocks listed here in the U.S. tumbled today because of that lack of new stimulus measure from Beijing. Worst day in a couple of years.
Yeah, absolutely astonishing here to see the unwind that we saw in some of those indices and ETFs. Meanwhile, in the yield space, I guess a relative calm compared to what we had seen in the previous days. That rout in the Treasury market easing here on this Tuesday afternoon. You saw a modest drop in yields on the shorter end of the curve, down about 3 basis points on the 2-year, and we're basically just going to call your 10 and 20-year unchanged. Your 30-year yield did tick up higher slightly as well, but once again, the moves too minuscule to really call it anything other than status quo.
All right, that's all the market wrap up. Getting ready for earnings and curious to see what CEOs and the C-suite have to say about kind of their workforce, because right now we've got already Home Depot saying that all of its corporate employees are required to work a full day, so a full 8 hours at its stores every quarter. They're trying to support their retail staff who have found it more and more challenging.
I think this is brilliant.
Yeah, me too.
For a few reasons. I mean, one, the whole idea of understanding what other employees go through, what your coworkers go through. If you're sitting in an office running a company that has so many workers on the front lines and trying to develop policies to interact with customers, ways to make things more efficient, ways to make employees work better. What better way to do that than actually going? I'm surprised this doesn't happen at every company.
Maybe this should be a new thing, like a new trend among leadership at for CEOs to have all the top senior executives spend some time on the front lines.
Yeah, and I mean, I was actually surprised that they weren't doing this already. I mean, you would think a company, particularly like Home Depot, that's so sort of customer forward there, would have already had something implemented. But I don't see anything but good coming out of this.
Right? Yeah, especially amid store theft and just the stress of it and. Anyway, so
store theft? Are you saying you're putting these people in harm's way now?
Well, people when there are people coming in and they might take something, a lot of the store employees are like, I can't stand in the way because who knows what's going to happen, right?
Yeah. You think the corporate employees are going to stand in the way?
Well, no, at least they'll understand what their employees are dealing with, right?
I got you.
Yeah.
Okay.
They can now see for themselves.
I was in a CVS and I saw the same thing. People walked in, the cashier looked at them, was like, oh, here it goes.
Here it goes, yeah. Let's see what happens.
They walked out with Funyuns and Skittles.
There you go. The other story that we're watching, which I thought was really interesting, was Qantas Airways apologizing after it inadvertently put on a movie for everyone across every screen in the cabin, which was it was called Daddy-O with Dakota Johnson and Sean Penn, and it was an R-rated movie, and there were some adult topics in the movie, but it was playing for everyone because there's a problem with the screen and people couldn't make their own individual movie selection. So Qantas had to apologize, but rival carrier Air New Zealand tweeted out that plot twist, we let you choose your own movies as a way to troll Qantas.
So Daddy-O on every screenio, huh?
Yeah, there you go.
That was Baddie-O.
Yeah, apparently users on Reddit said it was impossible for individual passengers to turn off the movie.
What do you guys do? Like, every once in a while you watch a movie and there's obviously a scene that it's not that it's R-rated, but
uncomfortable.
I get uncomfortable when I look at the person next to me and I'm like, oh, should I shut this off? It's a weird
Well, they
thing.
have warnings now on some of the movies that you choose.
Yeah. But when it happens, it happens, right?
They blur out some stuff,
just
right?
keep in mind that there are other people around when you're watching this. I've seen that.
Huh. Yeah. Okay. Interesting.
You got nothing for us, Romain?
Huh?
Get nothing?
No, I just read.
To this.
I just read Carol Massar.
Old
I just read my books. Little Shakespeare. Adam Smith.
Nice.
Light reading.
Don't believe it, everybody.
The wealth of nations with Romaine.
That's right.
All right, moving along. That's going to do
Actually,
it.
it's a theory of moral sentiment, but close.
You're just such an interesting guy. All right, across.
I'm watching Veep, and he's reading, Adam Smith. Okay.
I'm watching Emily in Paris. All right, guys, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals, we do it all. Scarlett and Romaine continuing on TV. We're going to continue here on YouTube and, of course, on Bloomberg Radio. We'll see you same time, same place tomorrow.
And our coverage continues here on Bloomberg Television with lots of expectations for what the days and weeks after the presidential election here in the U.S. could look like, including a boom in shareholder activism. A conversation up ahead with Kai Liekefett, partner and co-chair of shareholder activism and corporate defense practice over at Sidley Austin. Stick with us. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. A big turnaround in U.S. markets from what we saw yesterday, coming off of roughly a 1% decline on Monday, clawing back all those losses and then some. An S&P 500 that flirted with yet another record high. It closed right around 57.51 with that record high just around that 57.63 mark. The NASDAQ 100, though, was out in front. That was your outperformer, a 1.5% gain as those big cap names, the Magnificent Seven, well, they showed exactly why they were so magnificent. Not so magnificent, though, Scarlett, is what we saw coming out of Asia with mainland markets reopening. It was kind of interesting to see a bit of selling in those high-flying names that we had over the last few days, primarily through those ETFs and indexes. But today, seeing a bit of a pullback, some profit taking, if you will, in that space.
Yeah, well, expectations had gotten so high and investors had gotten accustomed to new positive catalysts from the government every day, and that didn't come through. All right, let's take a look at some individual movers. Robinhood climbing almost 10% on the day. The financial trading platform announced plans to host its first investor day on December 4th in New York, and the plan there is to share more about its 10-plus year plan, its long-term plan. And Roblox down 2%, but at one point it was lower by almost 9.5%. Still, this is a stock that's lost ground for 6 straight days. This is after short seller Hindenburg Research said it's betting against the video game platform company, accusing it of inflating key metrics and saying that it doesn't have sufficient safety screens. We should note that Roblox has denied these claims.
All right, let's turn now, I guess, to the world of shareholder activism. Pfizer, Southwest, CVS, all currently embroiled in activist battles, and even more campaigns may be looming, according to Bloomberg Intelligence. That team writing that, quote, the next 2 years may see a reacceleration of shareholder activism based on prior election cycles. Joining us now to discuss the landscape is Kai Liekefett. He's partner and co-chair of shareholder activism and corporate defense at Sidley Austin. The law firm has been ranked #1 globally in the U.S. for legal shareholder activism defense by Bloomberg for 2022, 2023, and the first half of 2024. Hopefully the second half went well for you, too.
I hope so, too.
Let's talk a little bit about some of the campaigns, because I feel like this has been a pretty active year. I mean, we've seen Elliott, I feel like they're going after everybody. Starboard has gotten into it, and even a couple of smaller players that we don't always talk about. But a lot of that was front-weighted towards maybe in the first and second quarter. The last couple of months, we haven't seen as much activity. Why has that gone down?
Yeah, that's very interesting. It's a very good observation, Romaine. Yes, Elliott has been the 800-pound gorilla in corporate America and, quite frankly, worldwide. They have built a machine. They go after any company that is underperforming and has a decent size. But in the last several months, it has calmed down a little bit in corporate America, at least. Why? Well, because the elections are around the corner. And what the business community needs most right now is certainty. And the election outcome is as uncertain as it gets.
When we talk about that level of certainty that will come post November 5th, maybe when we get to the inauguration in January, is there a sense here that the environment to wage activist campaigns will be different, will be better than what it is now, or even worse?
It might be. It also depends a lot, obviously, on the economy. What activists are always looking for is M&A as an exit strategy. And in order to have M&A as an exit strategy, you need to have a fluid M&A market. And the M&A markets have been, well, spotty in recent years. Now that the interest rates are coming down and hopefully the election drama is soon behind us, either in January or maybe even a little bit earlier, the hope is that M&A is on the table again, and by extension, activists have a great way to monetize their investments.
Let's talk about one specific campaign. You mentioned Elliott. It's been pressuring for change at Southwest, LUV, and has been threatening to call a special meeting to replace the board. It definitely wants to oust the current CEO, Bob Jordan. It's already had some success with the chairman. What's your view of how this is going to play out? Because what they want there is wholesale change, including the whole thing about paying for your luggage, right? I mean, getting charged for your luggage fees. That's something that distinguishes Southwest from its competitors. But if it gives way, then it's just another airline.
It's a fair question. Look, I mean, Southwest is a special campaign. The company has been underperforming its peers for years in terms of share price. It's very vulnerable. But still, the company, at least at the outset, treated Elliott like it was a terrorist. And if you do that, well, the price for a settlement, meaning an amicable resolution, goes up, not down. And I think that has made it very difficult to find a settlement here. Now already 6 independent directors have retired, and Elliott is looking to call a special meeting. However, what you need to know is Elliott actually doesn't want to launch a special meeting proxy fight. Why? Well, it's very difficult to win a proxy fight as an activist anyway. First of all, it's expensive. Second of all, it's time-consuming. It involves opportunity cost for an activist. And third, you could lose. And if you lose a lot of proxy fights as an activist, no one takes you seriously anymore. That's why Elliott has been so reluctant to call a special meeting, because Elliott hasn't launched a proxy fight since 2017.
Oh, interesting. Okay. So it's more bark than it is bite, actually.
That's exactly the way to describe it. It's way safer to bark than to bite as an activist.
I am curious. Okay, well, that's a good point, too. I am curious, though, when we talk about this idea of the environment for M&A deals and all the other components that would go along with an activist strategy, there are a lot of people that have already looked at this market and they say, look, we're ripe for an increase in M&A activity, certainly into 2025, not just because of the election, but obviously rates, macro conditions, confidence, et cetera. Are you predicting a significant increase in M&A activity for next year?
Absolutely. I mean, that's what we hear from our M&A colleagues. I mean, our private equity clients are barely sleeping, looking at deals. And with the private equity markets, also strategic buyers are looking at potentially buying companies. So we have a lot of potential would-be buyers chomping at the bit.
Chomping at the bit. And as you mentioned strategic acquisitions. That's sort of been hamstrung partly because of the regulatory environment, or at least the prospect that you're going to get sued by the government for some of these strategic deals for being anti-competitive, whether that's true or not, who knows. But Jamie Dimon, who runs JP Morgan, he was asked about this earlier today, and he talked about this idea of a regulatory environment that just was hostile right now to M&A. It was hostile to companies going public, and he really scratched his head as to how you could have these rising valuations all year long, but not a real reopening of the IPO market.
Yeah, look, Jamie Dimon is one of the smartest people in corporate America, so I'll take his word. At the end of the day, though, I mean, private equity funds are sitting on billions of dollars of dry powder. Yeah. And they're not in the business of returning that dry powder to their investors. So they're going to use it regardless of the regulatory environment. Does that mean that you cannot do certain big-time deals? Yes, that makes it's hard to do that. But there are a lot of deals that may not be big enough for you to report on because it's only $2, $3, $4, $5 billion, were actually way south of the regulatory threshold and can be completed even in this environment.
Kai, you spend 100% of your time on shareholder activism campaigns, proxy fights, and hostile takeovers. For the companies that want to avoid being targeted by activist shareholders, is it as simple as just making sure your share price is buoyant and that's it?
Yeah, that's the number one vulnerability is your share price performance. I mean, if you perform well and you print money for your shareholders, you can literally commit crimes against corporate governance on live TV. No one would care. But once your share price has a little bit of an issue, activists will be there because they are professional Tuesday morning quarterbacks.
Yeah, well, I mean, that's why some companies have those dual class shares, right? So that they can, even if their shares come under pressure, they still hold control of the voting shares. I think about Fox, for instance, that has that.
Right, and it's interesting. We see right now a campaign at Fox News, the parent company of Fox News, where Starboard is actually trying to eliminate the dual-class share structure there. The problem is, all they can do is file a non-binding proposal, and well, it is non-binding, and at the end of the day, the Murdoch family would still have to give up control voluntarily. And I think there's a better chance that Rupert Murdoch will embrace and endorse Kamala Harris for president.
Again, back to that all bark, no bite, right?
Yes.
Kai Liekefett, partner and co-chair of shareholder activism and corporate defense at Sidley Austin. All you have to do to fend off activist investors is to keep your share price surging.
Yeah, I'm going to start watching Succession here because apparently this dovetails a lot. You know what I saw for the first time?
What?
I actually watched 2 episodes of Industry.
And?
So now I'm a couch potato.
What you don't know is that Romain watches like
pounds.
little to no TV whatsoever. I'm always trying to engage him in conversations about TV shows.
It was a lot.
It's a lot,
And then my wife just sat on the couch saying she had no idea what was going on. And why
we can talk more about this later. We can just dismantle the whole thing. All right, coming up, we've got the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. This is the close. Are you? It's time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Robert Saleh, the New York Jets head coach, fired after the team's disappointing 2-3 start to the 2024 season. Jets owner Woody Johnson saying this was not an easy decision, but we're not where we should be given our expectations.
Okay, sure. Did they fire Aaron Rodgers?
No. You can't fire him.
Okay.
So, you do the next best thing, you fire the coach.
Yeah, I mean, I'm a Jets hater, so, I really don't care about him or Aaron Rodgers. Though, I'm told that one of our producers is a big Jets fan here. And apparently, I don't know. She was
really happy about it, but
she come to work today? Or
she did, because it came out during the workday, but she's saying the offensive coordinator has to be the next one to go.
She's calling for more firings. All right. Well, there you go here. A person I'm keeping an eye on is Jeffrey Hinton, the godfather of AI, finally getting his due, awarded the Nobel Prize in physics. Now, this is interesting for a couple reasons. So Hinton is sort of a pioneer in sort of neural networks and everything else, and he won it along with John Hopefield. But one funny thing I found about it, when I saw this, I was like, physics? And even he had a pretty good quip. He said, look, if there was a Nobel Prize for computer science, that would be the more appropriate thing, but I guess they got to sandwich this in somewhere. But it is kind of interesting. It is kind of an acknowledgement of AI overall, what it's become, what it's been, and obviously 2 of the big pioneers there.
And his work laid the foundations for today's machine learning apps. But the thing is, that's interesting also, is that Hinton in recent years has really warned about AI becoming too powerful. He actually left Google's AI research team last year so that he could speak more freely on the risks of AI. All right, third on the docket is Jamie Dimon. The JP Morgan CEO says the U.S. has become anti-M&A. Dimon spoke with Bloomberg's Lisa Bromwitz earlier today in London. Take a listen to what he said.
There's a pretty good backlog growing of IPOs of companies. Whether it happens or not is a different thing. And M&A, yes, I do believe, I can't prove it's more anecdotal, that it's tampered quite a bit by not the election, maybe the election, but by rules and regulations.
Feels like we've been waiting for some consolidation in the banking space for a long time, and it has not come.
Yeah, and it gets to this broader idea, though, too, of the idea that is the government really standing in the way of more public markets activity, whether it's M&A, whether it's IPOs and things like that. The Greenwich Economic Forum is taking place in Connecticut today and tomorrow, and I had a chance to get up there earlier today. I had a chance to sit down with Brad Jacobs over at GXO, as well as Ken Kinsell, who runs Churchill Capital, and I asked them about them. Both of these guys are prolific when it comes to that environment, and they had a lot to say about it, particularly about this idea here that what's ailing that space right now is less regulation. That, it certainly cast a pall over it, but they said it's much more about economics and and finding the right deals. And they really do think we're going to see an upswing heading into 2025, as I think a lot of what held this market back in 2024, that starts to dissipate.
So the regulators are just a convenient scapegoat for all of this.
Well, they make the good point, though. How many wins have they had? They're out there. It's kind of the bark versus bite that we were talking about a little bit earlier. Yeah, they're barking, and that's scaring some people away. But at some point, people start to to realize that, look, if we can beat them in court, then why not just
It just becomes a more expensive proposition, right?
Yeah.
Something that takes a long time. And you have to get investors on board to kind of wait it out with you.
Yeah. Well, that was one of the anecdotes, too. You know, it's like in the old days, you know, the first person you called if you wanted to do an M&A deal, if you were a CEO, you called, you know, your accountant, the finance people. Now the first person you call are your lobbyists and lawyers in Washington to see if whether or not that thing can get done. All right, when we come back after the break here, we're going to go take a look back in history at Martha Stewart's rise and fall from millionaire lifestyle entrepreneur to millionaire federal inmate. Dun dun.
That's a good one.
This is The Close on Bloomberg. All right, let's take a look back at this day in history. October 8th, 2004, the day lifestyle guru Martha Stewart, the doyen of domesticity, became inmate number 5517054, reporting to a federal prison camp in Alderson, West Virginia at just after 6 a.m. that morning. It was the culmination of a 3-year-long saga involving the sale of roughly 4,000 shares of the biotech company ImClone. It was a sale that the SEC and prosecutors said relied on material non-public information from her broker at Merrill Lynch. It was a sale that occurred on December 27, 2001, a day before federal regulators rejected an application for Erbitux, a drug that ImClone made. The day following her sale, the stock plunged 16%, helping Stewart avoid a financial loss of roughly $46,000, which is kind of crazy to think about it, that a person who had spent 2 decades building a billion-dollar home-making empire and had a net worth of hundreds of millions of dollars at the time would be upended by the sale of just tens of thousands of dollars worth of stock. But crime and celebrity, they're red meat for prosecutors, looking to make an example of someone rich and famous, and the public, of course, likes nothing better than a good fall from grace story. Stewart was initially indicted on 9 counts, and jurors concluded after just about 2 months of testimony and 3 days of deliberations, they determined that Stewart deceived investigators about why she sold the ImClone shares. She was ordered to serve a 5-month prison sentence, followed by an additional 5 months of home confinement. But it should be noted, her home confinement was at her sprawling estate in Bedford, New York. And the prison she went to, a minimum security facility with no barbed wires, was often derided as Camp Cupcake. Local residents even referred to it as the local college campus. Now, prior to Martha Stewart, Martha Stewart, the most famous inmates at that facility included Billie Holiday, Tokyo Rose, and would-be presidential assassins Squeaky Fromm and Sarah Jane Moore. In true Martha Stewart fashion, though, she entered prison with a flowery PR statement where she said she was looking forward to returning to work in the 5 months in March and enjoying many brighter days ahead, which she did. After being released in March 2005, she boarded a private jet to her home in New York, where she immediately went back to work on rebuilding that media empire. There you have it.
There you have it. And her story inspired one of the characters in Orange is the New Black. There was like some woman who's had a homemaking empire, and she was also in prison for a short period of time. But I don't think anyone called it Camp Cupcake at the time. All right, from 1 millionaire to 2 billionaires. Today, Bloomberg's Jason Kelly and Julie Fine spoke with the NFL Cowboys owner Jerry Jones and Penske Automotive CEO Roger Penske in an exclusive interview. Jones told Julie that he sees huge growth left as private equity enters the NFL.
When I look ahead from now, as I look into the future, that being able to take and sell parts of these teams, the demand being there to invest for parts of the team going forward, because I think there's huge growth left. When I look at that, I see a plus for running off tackle and throwing touchdown passes for the game itself.
All right, so Julie Fine, Bloomberg's Texas bureau chief, joins us now with more on this story. Julie, great interview, and I can't wait to see the rest of it. Jerry Jones talked generally about growth, huge growth, but did he get into the specifics of the Dallas Cowboys and private equity?
We did not get any specifics from him about the Dallas Cowboys. I did this interview with Jason Kelly, and I can tell you that we tried. Again, Sportico has named it the most valuable franchise in the world. So obviously it would be very interesting if this was up for sale. He did not say that specifically. What he really talked about is his family being involved in the team. He did speak about it in the generalities that you just saw, but overall, he did not say the Dallas Cowboys are up for sale.
Give us a sense here, though. I mean, and look, he doesn't have to say it. I mean, we can all speculate, particularly given his age. And with the sort of the new rules allowing private equity to sort of be involved in this space, I am curious as to how receptive he was to that proposal. I don't know if he voted for it or not, but how receptive he was to it, and more importantly, how receptive the Cowboys themselves would be to it.
You know, he did not say, again, what he's doing specifically with the team. What he generally likes to talk about is growth in the NFL, which he always says is good. And he also, I do want to point out, when it comes to him being older, his children are intricately involved with the Cowboys. His daughter's the vice president, the chief brand officer, his son's involved as well. So that is a family that is going to be involved with the Dallas Cowboys for some time. Again, as you know, it's only up to 10% if he does sell shares of the team, or if anybody does. So in that respect, his family is really still very involved with the team.
And it wasn't just Jerry Jones he spoke with. He was there with Roger Penske for the interview. And it's because Penske and Jones and the Texas Rangers are all teaming up for an IndyCar event in Arlington, Texas. It'll be a track that goes by both of their stadiums. How did that partnership come together?
Well, first of all, these two men have known each other, we found out today, for 25 years. But it was actually Penske's son, Greg, when they were looking at other locations, said this would be a great place for an IndyCar event. And that whole area, there's an entertainment venue there as well. So this track will go through all of it. They're hoping to bring 150,000 people to this race in 2026. So again, the two very excited. They said they've been talking about this for several years, Scarlett.
All right, Julie, great stuff here and a great interview here. We'll sit down with Penske and Jones there, Jerry Jones, of course, of the Dallas Cowboys, as we pivot from Julie Fine to Curry Wine, the gridiron to the vineyard. We spoke to the co-founders of Domaine Curry Wines, Ayesha Curry and her sister-in-law, Sydel Curry-Lee, expanding their presence in the industry. They told us about their journey as founders and sommeliers and how they hope to make the wine space more inclusive, and how their recent partnership with the Prisoner Wine Company is helping them grow their brand.
When the Prisoner Wine came to us and said, hey, we can help you, amplify this, we were all for it. But more importantly, because we were now surrounded by this amazing team of women winemakers, which was very important for us.
I am curious with regards to the partnership. You mentioned women winemakers, obviously black winemakers as well. Somewhat of a rarity, not somewhat, an overwhelming rarity in this business here. Do you lose control of that through this partnership, or do you maintain that veneer?
Absolutely. One of the main things we talked about in our meetings and discussions up until the acquisition was how much we wanted to be involved. We have to be involved in Domaine Curry because this is our legacy. We started this for the legacy of the Curry women, our daughters, my nieces, so we want to keep that going. And just because we are acquired by another company doesn't mean that we lose sight of that at all.
Your sisters-in-law who co-founded your own wine brand, Domaine Curry, back in 2015. But initially you kind of struggled to get the brand off the ground and get the industry to take you seriously. Why do you think that is?
At first glance, I think the industry can be very intimidating, and you think that there are these constructs that you have to stay within. And so for us, it took us a while to realize that we could really stand on our own two legs with our own vision and be able to grow the brand and make it what we want, and really, infuse our essence into the brand and really stand on the fact that 12% of people who are buying wine in the wine industry are Black and Black females, and that there's a market for it. There's $1.6 trillion worth of revenue going around when it comes to people in the marketplace buying wine that are people of color. And so for us, standing on that and infusing who we are, into the wine is so important because it's important to fill that white space in the market.
It was wonderful working with the prisoner and just really showing repackaging, redoing the whole design. We came up with a new emblem that shows, one of the things we talk about is we I'm blanking. Sorry.
Well, I think what's more important is everything that we do now is research based.
Yes.
And I think that that's so beautiful. So we're listening to our consumers all of the time and really putting product out into the marketplace that people want, which happens to, ride on the heels of that femininity,
yes.
which is great. And so it is, the product is a way for us to pay homage to the women in our family and women around the world. And so
what was the primary way that you used to sort of get the word out? Was it through social media? Was it through traditional retail channels? What?
Yeah, a lot of our background is through social media.
Yeah,
Ayesha,
we know. We've seen her
is
all over
like
the
2013 was when she's like the base, the core, the OG of social media, and so that's a huge thing that helped us as well, and just kind of the partners that we had having their resources as well, using them as well. But social media is a wonderful thing that can really push forward our passion projects, and so we're happy that we're 10 years into this and still going strong.
Well, I asked that question too because, you have to try to differentiate yourself. Anyone who walks into a wine shop, there's a ton of selection out there. And for those of us who maybe aren't as experienced in it, you don't really know what to pick. You either just pick something because you like the label or maybe somebody recommends it to you. So, in being able to stand out and say, this is Domaine Curry, this is worth buying versus, whatever you're competing against.
This is why we wanted to venture into this with fresh eyes. We've always said we're not yet wine experts, we're students of wine. And so we feel like that lends an approachability to the wine that we're providing for our consumer. And we're really proud of that. It's an ongoing journey. It's a lifelong journey. And
well, I'm curious on that too, because you talk about this idea that you're not experts. And I've interviewed a couple of other black wine vineyard owners and winemakers, and they talk a lot about being able to market this wine to folks who maybe weren't traditionally sort of in that sort of clubby experience. So they came up with more creative names and more creative labels as a way to sort of not just get attention, but to connect with a certain audience here. So how much thought did you two specifically put into that type of marketing when you were first launching the brand?
I think that we tried to keep this as authentic and genuine as possible. And the reason we started this was because the community that we have built in our family and wanting to share that with the rest of the world. As mothers and wives and entrepreneurs, community is so huge for us. And when we were coming up, trying to figure out what we wanted to partner with, wine was just such an authentic thing because a lot of the moments that we have shared in our family and with our friends have been surrounded by a bottle of wine. And so it can just be that. Like you open a bottle of wine, you smell it, it brings you back to a memory, or you're making a memory in that moment. So
it's very personal.
Absolutely.
When you dig into wine demographics, black women actually lead the way in buying premium wines. Since 2015, when you first began this adventure, when you first began this business, how do you see the wine industry changing the way that it targets black women as a demographic, as that target consumer?
I think to the point where it's not a trend, it becomes a lifestyle, a wine lifestyle. And I hope that we're able to lead the way with that. Because you look at a bottle of Domaine Curry, there's nothing calling to it that's going to make you think that it's for one type of demographic. That's not what we're doing here. This is for everybody. Sure. But we want to make sure that we're filling that gap in the marketplace with people who look like us and, maybe do some of the same things we do to let you know that, hey, wine's approachable. You can enjoy a glass anytime you like, and here are amazing SKUs for you to try that aren't intimidating.
You're launching a couple of new vintage, or a couple of new models coming out of that 2022 vintage, a blend and a Cabernet Sauvignon. Is that right?
And we're super excited about this vintage. We're about 14, 15 months into this with Prisoner, and so being able to now come to our second vintage with these two wines is so exciting, and we're so excited for the future.
What specific wines are you looking to introduce in years to come? In terms of some kind of blueprint, what do you have for 5 years down the road?
I'm are we allowed to talk about that? We are actively working on something that's in a more accessible, approachable, everyday price point, and we're extremely excited about that. That's us listening to our consumer So we're in the process of that. I mean, we would love to see some bubbles or a true champagne.
We have a lot of bubbles moments in our family, so it would be nice eventually to have something like that. But it's nice. The sky's the limit, really. So we love all the feedback that we're getting, and just to give more to our consumers.
And that was our conversation with Ayesha Curry and Sydel Curry-Lee, the co-founders of Domaine Curry Wines. It's like naming, your next wine brand House Bostic.
Yeah, I mean, sure. Why not name it after yourself? At least if you're, famous like
if your name carries the weight, yeah.
Yeah, I mean, everyone knows Ayesha Curry, and Sydel Curry's obviously making a name for herself as well. And good for them, too. I mean, I've heard a lot of great things about Prisoner. There have been other celebrities that have partnered with Prisoner wine. And I remember once I actually bought a bottle of some celebrity wine. I kind of derided it, and somebody's like, no, this is legit. It's done by Prisoner, and they actually do some really great blends there. So kudos to them, and we'll be interested to see what their next move is going to be.
Absolutely. Yeah. All right, let's just give you a quick recap of what happened in trading today. We basically clawed back all our losses from yesterday, with the S&P 500 closing up almost 1%. Big tech led the way, specifically semiconductor names, specifically NVIDIA. No real movement in the Treasury market. The 10-year yield pretty much flat at 4.01%. And NYMEX crude snapping its 5-day rally. WTI back below $74 a barrel. We're still awaiting any kind of Israeli retaliation for Iran's strikes on the country. This is The Close on Bloomberg.
All right, using the mapping function on the Bloomberg terminal, you can track the path of Hurricane Milton, now nearing Florida at Category 4 strength. Based on Bloomberg's modeling, it could make landfall sometime Wednesday night into Thursday, particularly hitting the Tampa Bay region the hardest. Of course, this is one of the fastest growing metropolitan areas in all of the U.S., and it's raising a lot of questions here about some of the migration we've seen around the country and whether it's left a lot of folks exposed to the increase in climate disasters. Sarah Labowitz joining us right now. She's a non-resident scholar in the Sustainability, Climate, and Geopolitics program at the Carnegie Endowment for International Peace. Sarah, pleased to have you here on the program, and really want to get your expertise on this, particularly given the fact that we saw Hurricane Helene primarily hit an area, at least the remnants of that hit an area that in theory should have been out of the path of a hurricane, or at least out of the path of flooding in terms of what we saw in North Carolina. And now as we have a city like Tampa Bay, St. Petersburg, this entire metropolitan area that has been spared these types of storms now for decades. And it looks like, at least right now, they're in the direct path of it.
Yeah, well, first of all, it's great to be with you. And I'm here in Houston, Texas, and we have a lot of disasters here. And I just want to send all my sort of good thoughts to everyone in North Carolina, Georgia, and certainly Florida. These are scary times. And I really appreciate you guys covering this, because people are in for just a really hard next few weeks. Yeah, we're seeing a real increase in the kinds of climate disasters, the intensity of the disasters. And I think it's sort of easy to think, in the future, the climate will be different. And really what we've seen this summer and what we're seeing really this week is that the climate of the future is here now. We're experiencing this real intensity. Is it too late to, I guess, do anything to sort of arrest this? Because we're talking about an increase in storms. Every year we talk about this for the last few years, the increase in number of storms, the severity of the storms that actually do hit. And then, of course, we're dealing with this whole issue of whether we even have the funding here to deal with these disasters once they actually happen. Yeah, I mean, there is a lot of work happening on how to reduce emissions and to try and bring those temperatures down. That's really essential work. I think the other piece of the equation is how do we adapt to the climate that's already here. And before we talk about federal funding and that sort of thing, I want to say there's a lot of just like rumors and lies and stuff going around that is confusing people about federal money. And so I want to just say at the outset that people should apply for FEMA. And it's disasterassistance.gov. Everyone who's impacted should apply. FEMA is saying there's enough money for immediate needs. So I don't want to miss the chance to say that that's the first thing you should do if you're directly impacted.
Thank you for making that clear. I guess what's different this time around is Milton is coming on the heels of Helene, and the region is just now recovering from that storm. So even as you say there is funding, people should apply to FEMA, is there reason to be concerned that the system is not set up for people to apply for aid so quickly after a previous storm, that these are two distinct storm systems, two distinct events, but it'll kind of get lumped together because it comes so close together?
Yeah, there's thousands of people from FEMA on the ground across the region, and they are used to this. They deal with multiple storms in the same season. What I think is important to understand is that those kind of emergency, immediate assistance programs for individuals from FEMA is just one piece of a bigger system. And so, the system is designed to have multiple kinds of federal programs, the insurance sector, the private sector, the charitable sector, all working together to help people recover. And so in the short term, it looks like there is enough money and everyone should go ahead and apply. But if we start to get into the medium term, the long term, and there's a deficit of money, that's going to be because there's a deficit of leadership in moving that money to communities.
Okay, and that's an important distinction. As we were talking earlier, Romaine mentioned how Tampa Bay has seen tremendous population growth. It's clearly a hub of business in Florida overall, covering Tampa, St. Petersburg, and Clearwater. What is the most effective role for the private sector, for these companies that have really grown their presence in the area? What role can they play? How can they best contribute to the preparation for the storm and the cleanup after the storm?
Yeah, and I think as we think about disaster recovery, getting people back to work, getting the economy going again is one of the main goals of everybody involved in disaster recovery. And private companies play a role both in the preparation. They need to be giving their employees time off so that they can evacuate. They can play a role in helping clarify messaging. We're seeing, again, these just like rumors and lies, and speaking clearly about evacuation orders, following what your local officials, what FEMA are saying. And then in the immediate aftermath, we see oftentimes companies involved in the disaster relief effort, delivering supplies and that sort of thing. But I think more broadly that we need communities where these businesses are based are going to need a lot of support to get back and to reopen schools and to do the many different things that allow the local economy to get back in gear.
A lot of companies, of course, that have set up shop down there, of course, a lot of infrastructure that's gone along with it here. So potentially a lot that will have to be repaired. Of course, the storm has not hit, but we will continue to monitor it. Sarah Labowitz over at the Carnegie Endowment for International Peace. And you can use the Bloomberg terminal to track the path of Hurricane Milton. In the meantime, we will set you up for some of the potential market moving events over the next 24 hours. Stick with us. This is Bloomberg. Some of the potential market moving events over the next 24 hours includes MBA mortgage applications coming out at 7 a.m. tomorrow in Washington. That's followed by wholesale inventories at 10 a.m. And we do get, more Fed stuff tomorrow, Scarlett.
Yeah, we get the FOMC minutes at 2 p.m. and a bunch of Fed speakers, Bostic, Logan, Goolsbee, Collins, Daly.
Which one's your favorite?
It doesn't matter because we're all waiting for CPI.
After market, we're going to get some earnings out of Applied Digital. And get this, Scarlett, early voting is actually starting.
Already? Oh my God. Arizona, Missouri, and a couple of other places. And in D.C., we should mention, Israel's defense minister set to meet with the defense secretary.
All right, stick around. Balance of Power coming up next at the top of the hour, right here on Bloomberg.